Okay, let's unpack this. Think about this for a second. What if those things you regularly buy, from your morning coffee to your online shopping haul, suddenly cost more?
Mm.
High tariffs they could do just that, leaving you with less wiggle room in your budget,
Yeah, definitely less flexibility.
and maybe even making you think twice before swiping that credit card.
Which leads right to the big question, doesn't it?
Exactly. How are the major players in the credit card world, American Express, Discover, MasterCard, and Visa, how are they positioned to handle any potential um, economic bumps in the road?
Now, the analysis we're looking at, it started with financial strength, specifically something called the assets to liabilities ratio. What does that actually tell us?
Yeah, the assets to liabilities ratio is a really fundamental measure. It's about a company's financial stability.
Okay.
Put simply, it compares what a company owns its assets to what it owes its liabilities. A higher ratio generally signals, stronger financial foundation. They're better equipped to handle their debts.
And if we look at the data here, Table 1, how do they stack up between 2021 and 2024?
We can see American Express is fairly consistent, kind of hovering around 1.12, 1.13. Discover starts a bit higher, dips slightly, but then gets back to 1.14 in 2024.
Okay.
MasterCard's in the 1.16 up to 1.24 range. But Visa really stands out.
How so?
They're consistently way up in the 1.7 to 1.8 range across all 4 years. That's quite a significant
Yes,
difference.
it really is. So that consistency points to more resilience for Visa.
Exactly. That's what's fascinating. It clearly suggests a more robust financial position compared to the others, at least over this period. Discover shows a good recovery in 2024, sure, but Visa's average is just significantly higher.
So the analysis gave Visa a point for that, for financial stability.
Correct. Based on that highest average ratio, Visa gets the point for being the most financially stable.
Okay, that's clear. Let's move on to the top line then. Revenue. Table 2 shows the revenue figures in millions for each one and the total market size. What's the big picture here?
Well, the most striking trend is just growth. Consistent growth across the board.
For everyone.
Pretty much. All four companies and the overall market saw revenues climb steadily from 2021 to 2024. It suggests a pretty healthy and expanding market for credit card payments overall.
And the market size itself grew quite a bit.
Oh, yeah. Went from roughly, $98 billion to nearly $148 billion in just those few years. That's substantial.
Wow. Okay. Now let's zoom in a bit on that growth. Table 3 shows the year-over-year revenue growth percentages. What catches your eye there?
Here we start to see some different patterns emerging. American Express, for instance, started with a really strong growth spurt in 2022, over 22%. But that pace has definitely moderated since then, down to about 9% in 2024.
Right. And Discover.
Discover's growth seems more, up and down. It's fluctuated between around 10% and nearly 20%.
Right.
In contrast, MasterCard and Visa, they demonstrate a more consistent growth trajectory. MasterCard's generally in the low to mid-teens, while Visa started higher but then settled into the low teens as well.
So more steady climbers, those two. And the point for the most consistently high growth went to?
MasterCard. Despite Amex having that big jump early on, MasterCard maintained a more consistently strong growth rate across all 3 years shown in that table.
Okay, so MasterCard gets the point for steady, strong revenue growth. Got it. All right, next up is market share. Table 4 breaks that down. Any big surprises in who holds the biggest piece of the pie?
Probably not a huge surprise for most people, no. American Express clearly leads here in terms of market share.
Consistently.
Yeah, consistently held the largest portion, somewhere between about 44% and 45% during these years.
And the others. Discover, MasterCard, Visa.
Their market shares have remained relatively stable in comparison. So, when you think about where a big chunk of credit card spending actually happens, American Express is definitely a major force.
And the analysis specifically awarded a point to American Express for that dominant market share, didn't it?
Exactly. Their established base, their cardholder spending, it gives them a pretty significant advantage in just overall market footprint.
Okay. Now let's shift focus a bit to how profitable these companies actually are. Table 5 shows us earnings per share, or EPS. For anyone maybe not super familiar, what exactly does EPS tell us?
Right, EPS, it's a really key indicator of a company's profitability, but specifically on a per-share basis.
Okay.
So think of it like this. How much profit did the company generate for each single share of its stock that's out there? Generally, a higher EPS means the company's more profitable.
And looking at these numbers in Table 5, Discover's EPS seems to be on a bit of a roller coaster.
That's a really good observation, yes. Discover's EPS shows some significant swings. It dropped quite a bit in 2023 before bouncing back really strongly in 2024.
And Amex had a dip, too.
American Express also saw a slight dip in 2023, yeah. But on the other hand, you look at MasterCard and Visa. They show a much more consistent upward trend in their EPS over this period.
Suggesting more stable profits for them.
It could suggest more stable underlying profitability, yes.
And who got the point for the most stable EPS trend?
That went to MasterCard.
Okay.
MasterCard demonstrated the most consistent growth, that steady increase year after year in EPS during this time frame.
Then Table 6 drills down into the actual EPS growth rates, the percentages. What are the key takeaways when we look at those numbers?
Yeah, here the differences become even clearer. You see American Express with that massive jump in EPS growth in 2022, like over 165%, but then it actually decreased slightly in 2023.
Wow, okay.
And Discover's volatility continues. Big drops in EPS growth in 22 and 23, then a huge increase in 2024.
So very choppy.
Very choppy. What really stands out for consistent positive growth are MasterCard and Visa. Their EPS growth rates stayed positive and relatively stable throughout the whole period.
Which points to more predictable profit growth.
Exactly. A more predictable growth engine for their profitability. And that consistent positive growth earned them both a point in the analysis.
Ah, okay. So 1 point each for MasterCard and Visa there.
Precisely. Their ability to just consistently grow earnings per share suggests, a strong and reliable profitability engine.
Okay, finally, let's talk valuation. How does the market value these companies? We're looking at the price to earnings, or PE ratio, in Table 7. Remind us what the PE ratio generally tells investors.
Sure. The PE ratio is a really common metric. It basically gauges how much investors are willing to pay for each dollar of a company's earnings.
Right.
Now, a PE ratio around 20 is often tossed around as a sort of general benchmark for a reasonably valued stock, but, that can definitely vary depending on the industry and market conditions.
And a higher PE suggests.
A higher PE might suggest investors have really high expectations for future growth. They're willing to pay a premium now. A lower PE, conversely, could indicate the stock is maybe undervalued or perhaps that growth expectations are lower.
And looking at Table 7, there's a pretty stark difference here. MasterCard and Visa have PE ratios significantly above that 20 mark, while American Express and Discover are below it.
It's a big difference, yeah.
Yeah.
MasterCard's up at 39.21, Visa at 34.48. Meanwhile, Amex is at 18.94, and Discover is at a notably low 9.82.
Okay, wow. So because Amex and Discover were below 20, the analysis gave them each a point.
That's right. The analysis awarded a point each to American Express and Discover, suggesting they might be seen as relatively more attractively valued by the market at this moment.
Okay, so let's just quickly tally up the points based on this specific analysis. American Express got 3 points, Discover got 2, MasterCard also got 3, and Visa ended up with 4 points.
Right.
So based purely on this scoring, Visa looks like the leader. But the analysis flags something pretty important about those higher PE ratios, especially for Visa and MasterCard, doesn't it?
Absolutely, and this is crucial. While Visa scored the most points across these different metrics, stability, revenue, EPS growth consistency, the analysis rightly points out a critical consideration, those high PE ratios for both Visa and MasterCard.
Okay, let's dig into that. What's the issue with a high PE?
Well, the implication is how that high valuation might normalize over time. The analysis explains that for their PE ratios to come down to a level more like that benchmark 20, one of two things generally needs to happen.
Which are?
Either their stock prices would have to decrease, or their earnings per share would have to increase significantly.
And predicting stock prices is tricky.
Notoriously difficult, yeah. So the analysis focuses on the other path. What level of EPS growth would actually be needed to bring those PE ratios down to 20, assuming the stock price stayed the same?
And the required EPS growth, it looks pretty substantial, right? That seems like the potential challenge here.
It really does.
Yeah.
It highlights a potential hurdle for future returns if that earnings growth doesn't materialize fast enough. For MasterCard, with its current share price around 546 cents and EPS of $13.87, well, the EPS would need to jump all the way to $27.30 to hit a PE of 20.
That's nearly double, a 97% increase.
Exactly. A huge leap needed in earnings per share. And for Visa, with a share price around $344 and EPS of $9.73, they'd need an EPS of $17.20. That still requires a very substantial 77% increase.
And the analysis basically says, look, that kind of jump in 1 year is pretty unlikely for companies this big.
Correct. It's just not realistic to expect that level of EPS growth in a single year.
So to put that into perspective, the analysis then looked at how long it might realistically take for their EPS to reach those levels, assuming they keep growing at their average historical rate.
Precisely, just to give a sense of the potential timeline. Using their average historical EPS growth rates, which were around 23.31% for MasterCard and 20.04% for Visa, the calculation suggests it would take both companies roughly 3 to 4 years.
3 to 4 years of continued strong growth just to get the PE ratio down to 20.
Potentially, yes. Assuming those growth rates hold steady and the stock price doesn't change drastically.
And this brings up a really important question for you, the listener, doesn't it? Are you willing to wait that 3 or 4 years for that potential valuation adjustment?
Especially when you factor in the dividend situation.
Right. The dividend yields are pretty low, aren't they? Less than 1% per year for both.
Yeah, quite low. So you're not getting paid much to wait, essentially. It really forces you to think about the opportunity cost. Is your money best placed here, waiting for that PE normalization, or could it be working harder elsewhere?
That's the core of the matter, really. The analysis basically lays out two main paths for someone considering investing in, say, Visa or MasterCard right now.
Exactly. One path is you take a long-term view. You buy, you hold, you collect those small dividends, and you wait, hoping that earnings per share eventually catch up to the stock price over several years.
And the other path?
The other is to pause and consider if there might be other investment opportunities out there that offer potentially faster growth or better returns in a shorter time frame.
It really just underscores that investing isn't one size fits all. It depends so much on your own goals, your timeline, your risk tolerance.
Absolutely.